On this video, we are going to go over one of the hottest stocks in the past months, which is NVIDIA. Just make sure to watch the video until the end because we have a very nice surprise for you. So without further ado, let's get into it. So NVIDIA engages in design and manufacture of computer graphic processors, and it's a very hot company right now because of the new revolutions around AI, and they believe that NVIDIA GPUs will be used in the advancement of AI. It has some merits to a point, but let's see if the valuation is reasonable. First thing first, let's take a look at their revenue. It has been growing steadily in the past 20 years, but in the past 7 years it has gone up 5 times. Let's take a look at its revenue breakdown. You can see almost half of its revenue is from compute and networking and the other half from graphics. And they are selling their services all around the world. So they're growing their revenue very fast. But how about the equity? That one is growing very fast too. But let's take a look at the breakdown of their balance sheet. You can see right now they have total asset of 44 billion and total liability of something like 20 billion. Let's dig deeper into their assets. 30% of their asset is in cash, which is really good. They can almost pay all their liabilities using their cash. They have lots of debt, but they can pay it off easily using their cash. Probably they have lots of long-term debt. As we can see here, 10 billion of long-term debt, and they needed to use this to build plants because they are growing really fast. Their current asset is something like more than 3 times their current liabilities, which is really good. So they have a strong balance sheet, but their retained earning is going down, so maybe we can take a look at that now. We can see that their return earning has gone down and the account for paid-in capital has gone up, which means they have been diluting their shareholders, which is something that we don't like. So that's a bad sign. Their return on employed capital is around 23%, which is pretty good. Their net margin a couple of years ago was around 13%, but now it's around 26%, so they have been working very efficiently recently, which is awesome. Their net income has been growing in the past years too, and the same goes for their free cash flow. They have a tiny dividend compared to their earning, but the fact that their share outstanding has been going up is a bad sign for me. 2 things can cause this. One of them is they are selling their shares to raise cash, or they have been giving away their shares to their employees as a stock options. So how can we find that? The best way is to take a look at their annual reports. For that, we can go to the NVIDIA website, or better yet, we can go to SEC website, search for NVIDIA, and take a look at their 10K. If we open their latest annual report and search for statements of cash flow, we can see that their net income last year was around 4 billion, and they had a stock-based compensation of 3 billion. It has been the same case for the last 2 years too, so they are paying a lot of stock options to their employees, which is understandable. They want to attract top talent, but when you have net income of 4 billion, it doesn't make sense to give 75% of it to your employees as a stock options. Right now their stock has risen a lot too, so this compensation is going higher and higher, which is a bad sign for us. Let's take a look at their income statement. They have a good gross margin of 60% and an operating margin of 25%, which is pretty good. They have been spending a lot of money on research and development, but in the business they are in, this is very much needed. So whenever they want to increase their income, they can just spend less on research and development and maybe pay less stock options to their employees. Their cash flow statement is strong too. We can see they need to spend 20% to 30% of cash from operation on capital expenditures, which is pretty good. So they are left with a lot of free cash flow, but they have been buying back a lot of stocks in the past year, and the number of shares outstanding has been going up, which shows they are diluting shareholders more than they are buying back shares. And their shares are very overpriced right now, so these buybacks does not make sense at all for the long-term shareholder. They have earning and free cash flow of around 5 billion, but their market cap is more than 1 trillion, which makes their PE 200, and it doesn't make sense at all. Investors have been counting on everything going perfectly for NVIDIA, and that usually doesn't happen. It's a great company, but the valuation right now does not make sense. So for now, we are gonna keep it in our watch list, but it's not a buy for us right now. Now it's time for the surprise I promised you. This is another service that I use daily. It's called Simply Wall Street. They have a great product. You can use their services in their apps or their website. Let's search for NVIDIA here too. You can find a lot of information in Simply Wall Street, and it helps you a lot with your research. But you can find an overview on their snowflake analysis. You can see NVIDIA has a great future, very healthy balance sheet, but their valuation does not make sense at all. If you scroll down, you can see more information. I love that you can read different news and announcements around the company that you are researching with an easy tap. You can see their breakdown of their revenue and expenses, comparison to their competitors, and a lot more. But as you can see, Simply Wall Street thinks that they are 160% overvalued, and I totally agree with them. They have analyst price target too, so as you can see, investors have been pricing in all the future growth right now. This part is one of my favorite parts, and that's the CEO compensation. And you can see their CEO has been getting 21 million of salary and stock options. But the good thing is he is a co-founder and he still owns 3.5% of the company, which is always a good sign when a founder is a big shareholder of the company and is still active in the business. They have other features too, like a screener. You can try to find the perfect company with your criteria. You can follow your portfolio here too. You can find a link in the description of the video to Simply Wall Street. They have been kind enough to give us a 40% discount, so make sure to use it. It costs $20 a month, but right now with the 40% discount, it's going to be $12. I suggest you get the ultimate account. That's what I'm using too. Thank you for watching the video. If you have liked the surprise, make sure to like the video, subscribe to the channel, and tap the bell button to get notification whenever I post another video. Have a great rest of the day and see you on the next one.